Thank you very much, and good afternoon, everybody. I suppose when we're thinking about the economy, a lot has changed, it seems, in a remarkably short space of time when I compare what we were thinking at the end of last year to what has happened in the early part of 2016. And what we're really seeing, I suppose, is that the same pessimism that has characterised views on the Australian economy in recent years is again on display. The same debate about the risks of a recession have resurfaced again, and it's easy in many ways to understand why. Now, we are going down that sort of depressingly familiar path that we've seen before of global growth, downgrades, rising financial market uncertainty and volatility, and of course just concerns about the economic outlook in general. Now, having dragged the mood down, I'd like to say right up front though, that I think when we get to the end of 2016 and look back, we'll see an economy that we'll probably be pretty happy with. So we think we'll continue to grow at a below-trend pace for sure this year, but it's a long way from that recession risk that features in the conversation. I think we'll be still looking at an unemployment rate that's too high, but we think jobs growth will be positive through that period. Now, these conclusions no doubt look a little bit optimistic when you benchmark them against the fear and loathing in financial markets right to now. But equally, I would say that it's when you benchmark that fear and loathing, that volatility against the economic fundamentals, then financial markets do appear to be far too pessimistic. Now, these couple of charts here give you a bit of a feel for what is going on. So the chart on the left-hand side, those different squiggles there show you how forecasts for global growth have evolved over the last few years. And as you can see, there's a pretty standard forecasting rule here. You start forecasting at around about 4% for global growth, round about trend, round about average. And then as reality disappoints, you just revise those forecasts lower. And for sure, when you look at the red line and the blue line at the end there, the forecast for 2016, 2017, we are going down that same path. The chart on the right, it shows you a couple of measures of financial market stress. Now, this covers a whole range of variables in global markets, equity markets, interest rate markets, currency markets, all sorts of things go into it. But the bottom line is the higher those lines are on the right-hand side there, the more stress is in the global financial system. And you can take that chart back 4 or 5 years, and the sort of readings that we're seeing right now are the highest in that 4 or 5 year period. So growth downgrades, financial market volatility, and obviously a lot of concerns about the outlook on the back of that. But there's a couple of points to note here, really. The forecast revisions that we've seen in the latest numbers don't reflect some sort of general malaise that's seeing everybody revised lower. It's a range of specifics. So not surprisingly, given what oil prices have done, forecasts for oil producers have been lowered. You do have some big economies like Brazil that are in recession for a range of reasons right now. So it's kind of country-specific factors that are driving the revisions. And what's, I suppose, particularly important from an Australian point of view is the forecast for China in that global mix haven't been changed. So it's not quite as bad news story as it perhaps might first appear on that front. Financial markets, as people like to say, they've correctly predicted 10 out of the last 3 recessions. So we can't necessarily read too much into that, but there is a risk, I will admit, that we see that volatility feed back into global growth concerns and then into sentiment and the real economy and so on. So we can't entirely ignore markets, but it does look overdone, as I said before, when you benchmark it against reality. So why are we seeing this volatility? Well, the fundamental factors, the explanations that you will hear people advance is the US Fed. They're lifting interest rates. People are worried about how far and fast that set of rate rises will go. We can point the finger at China as well. Markets worry about Chinese growth prospects. They worry about the ability of Chinese policymakers to control what's going on there these days. But again, you need to take a step back, I think, and put some of these concerns into perspective. So the chart on the right-hand side here, for example, shows you what's happening with US interest rates. And that little blip at the end there is what concerns market participants. But by any longer run stretch of the imagination or reality, US interest rates are still extremely low. And if we get another 2 or 3 rate rises this year, US interest rates will still be extremely low by the standards of history. In fact, what's interesting about this chart, I suppose, is the last time that the US raised interest rates, that we had one of these tightening cycles, was back in 2006. Back then, the iPhone didn't exist, to put it in some sort of context. So a lot of market players today haven't actually experienced a rate rise cycle, and that might explain some of the huge swings that we are seeing on that front. If we move over to China, well, the chart on the right there just shows you a few financial indicators for the Chinese economy, and just to pick one there, the black line shows you what's happening with the Chinese exchange rate against the US dollar. It has moved lower over the last couple of years. Some of those moves have created a lot of excitement and volatility in financial markets. But to put that into some perspective, over that period you can see on the chart the Chinese currency is weakened by 8%. Over that same period, the Aussie dollar dropped by 22%, and nobody really blinked an eye about that. So it does look again like an overreaction to what is really a very small move in a financial market price. I think there is one lesson that we should take away from this, though. Now, we have known for a long time now that, of course, what happens in China is critical in driving global growth. It's critical in driving commodity demand, but we haven't really paid much attention to Chinese financial markets. But it's now very clear that China's reached the point that what happens in financial markets there will impact on markets around the world. And my attempt to show this and to show my children that I'm kind of hip and with it and understand the technology. The chart here, the green line, it shows you a Google trend search for the words China economy. And you can see the various spikes that occur in that Google trend from time to time. The other line on the chart is something called the Vix Index. Now, it's actually a measure of volatility in US equity markets, but it's kind of universally known as the fear gauge. And whenever that index spikes up, it means there's a lot of volatility, uncertainty and concern in financial markets. And you can see the correlation that started to emerge there between those kind of spikes in concerns about China and their economy and that volatility and fear in financial markets. So certainly watching Chinese financial markets is now part of the job, I think. Of course, adding to the volatility and to the general fear has been the big collapse that we've seen in oil prices. And certainly looking back, those forecasts for a $200 a barrel oil that were pretty common a couple of years ago looked to be a little bit off the mark. And no doubt a lot of people are revising their forecasts lower on the back of what we've seen. What I haven't seen in the debate, though, is discussion about the positives from lower oil prices. It is certainly bad news for those countries producing and exporting oil, but it's actually quite good news for everybody else. And just one example, the chart on the left-hand side here, the brown line, it shows you the oil price. I plot it upside down, so as the line's rising, that means oil's actually going down. But typically what happens when you get those big moves is that growth in the advanced economies, the green line on that chart, tends to move in the same direction. And again, if we drag it back to an Australian perspective, the fact is most of our major trading partners are oil importers. They should be getting quite a big income benefit from the drop in oil prices, and of course it's a sort of environment where we should benefit. Likewise, while there is this focus on rising interest rates in the US, elsewhere it's a different story. In Europe, in Japan, they're still cutting interest rates, negative interest rates in play there, and they're still pursuing their quantitative easing programs, so they're still buying government bonds. And what that chart on the right-hand side shows you, it looks at new issuance of government bonds in Europe, in the US and in Japan, less the amount of those bonds that are being bought by central banks in those areas. And those negative bars on the end tell you that these central banks are actually buying more government bonds than are being issued. Now, it's a simple matter of demand and supply here. That demand from central banks is driving up the price, which of course means that yields are actually falling. So in some ways, it doesn't really matter what the Fed may do with short-term interest rates. Those longer-term interest rates that are more important for many economies in driving growth and the like are going to remain very low. So, I mean, the point here is that a lot of these factors, I think, that are seen as growth negatives, more closely looked, there are some positives in the story there that should receive equal attention. The one area where we have a little bit more concern about the story is we think the threat is not so much from volatile stock markets, volatile interest rate markets. Perhaps the bigger risk and the area to watch most closely this time around is currency markets. And I say that because we're now into a period where global growth or global trade growth pretty much appears to have come to a halt. The chart here, the brown line there, it shows you global trade as a percentage of global GDP. And after 20 years or so of pretty rapid growth in that important driver, it's gone sideways in the intervening period. And I think what we're seeing there is not just weak growth in the global economy, but more an indication of that period where global value chains, global production chains were being set up has come to an end. They're all now largely complete. Setting up those chains did drive global growth. Countries that fixed their growth strategies into that part of the story did pretty well through that period, particularly in the Asian region. But if that source of growth is no longer there, then growth in many of these countries is going to be more about what's happening in the domestic economy. And that means, I guess, from a policy perspective, the question is, how do you protect that domestic source of growth? How do you make sure it stays within your economy and doesn't spill out into other countries? And one of the ways you could pursue that objective is through a lower exchange rate. So I think it's no surprise that most countries these days actually want a lower exchange rate. Unfortunately, we can't all have that. So there's certainly a risk here. We think that currency wars is probably a little bit too much of an aggressive statement, but certainly there are plenty of risks there as we battle out on this currency front. And when it comes to these sort of generalised depreciations, one of the countries where you may see some upside pressure on the currency is in fact Australia. And of course, the last thing we want as well at the moment is a stronger Aussie dollar, now that we've kind of got it where we need to for our own economic considerations. But certainly watching the currency, I think, will be a pretty important indicator of risk in the broader story. Now, from what I've said so far, I think it's pretty obvious that we can see more global risks to the Australian story this year than domestic risks. But there are some local issues that are still playing out and will be important in how the economy performs this year. And these issues largely relate to the end of the resources boom and the fallout as commodity prices adjust lower and as that big mining construction boom winds down as well. The commodity price story translates through to an income risk in the Australian economy. And it's not just an income risk for commodity producers, it does work its way right through the Australian economic structure. So the chart on the left-hand side here, it shows you the broadest measure of Australian incomes. So it includes everything: government revenues, company profits, household incomes. In the last few years, we've seen income growing at rates that we'd normally expect to see in a recession. And in fact, you've got to go all the way back to the early 1960s to find anything that's been weaker than what we're experiencing right now. So that income pressure is certainly something that many companies are struggling with. The governments are clearly struggling with as they try to balance budgets and clearly something that pressures household finances as well. So probably the most important forecast any Australian economist has to do right now is the outlook for commodity prices. Now, there's a good reason we have a 3-page disclaimer on the end of this, but our commodity forecasts say there's a little bit more downside, but we think we are near the bottom of the cycle there. So that income drag shouldn't get any worse, and in fact things may improve a little. The other issue, the downturn in the mining construction story, well, we've never been particularly worried about that because we thought we were pretty nicely placed to export the problem in a sense. So the chart on the right-hand side, the green line there, it shows you mining investment as a share of Australian GDP, and you can see our forecast on the end. The purple line shows you the number of people that are involved in resource construction activity. Those two lines move pretty closely together, and if our forecasts are right, well, there's certainly a further drag coming through from mining capex and further job losses to come as well. But as I say, I think we can export our way out of the problem in a sense. Of course, all of those new mines we've been building, all those LNG plants that are still under construction are going to deliver something. And what they will deliver is a big increase in our resource exports. And the chart on the left-hand side here, it shows you the contribution to economic growth from resource exports. And over the next couple of years, that ramping up in LNG production in particular is going to add something like 1% to GDP growth each year over the next few years. So that's a very solid support to the economy and a solid offset to the drop-off in mining capex. On the labour market, we've also managed to export the problem there, and you can see some of the trends that have been important in the chart on the right-hand side. So what is happening is these projects come to an end. The really highly skilled construction workers who are here on 457 visas, the green line of the chart, well, they're moving on to wherever the next big project is around the world. So we've exported them. It turns out a lot of these construction workers actually came from New Zealand. And if you look at the purple line there, most of them have gone back to New Zealand. So we've exported the problem to them. And finally, because of the strange nature of these jobs, most of them are that fly in, fly out category. What's happening in a sense is that people are losing their jobs in the Pilbara, let's say, where they work, but they're actually becoming unemployed in Sydney and Melbourne and so on, where they live. And if you are going to lose your job, well, that's the best place to be right now, because it is where a lot of the new jobs are being created. So we've actually worked our way through this transition story in quite good shape. Economic growth is still positive, employment growth is still positive as well, despite the very big negatives that you've seen on those earlier charts. Can we keep it going, of course, is the real question. We do need to succeed in this transition towards non-mining led growth. And there's a couple of sectors there that we've been particularly keen to see work in this transition story. And I've picked those out on this chart here. So the idea was, as mining turns down, we'll have a pickup in residential construction, and that's certainly been happening. There's a major residential construction boom underway. We also wanted to see non-mining parts of the economy increase their business investment spending. But if you look at the blue line on the chart, that hasn't really happened. We've just tracked sideways through that period. The real disappointment, though, has been the green line, government infrastructure spending. What that chart's actually telling you is that government infrastructure spending today is 30% lower than it was back in 2012 at the height of the mining construction boom. So far from adding to growth, it's actually been one of the weaker parts of the economic story and a significant drag on the economy as a result. So we really do need to see that part of the story kick in over the next couple of years. We do need to see an increase in infrastructure spending, and I think pretty much every economist in the land would agree that it's a no-brainer. It's a great thing for supporting short-term demand in the economy. It's also something that adds to long-term productivity growth, which is essential for the longer-run health of the economy as well. And to be honest, when governments can borrow pretty much as much money as they like at 2.5% for 10-year money right now, if there isn't a whole range of projects that we can think of that will pay better than a 2.5% rate of return, we're not really trying, I suspect. So that's where we're hoping to see some increasing activity come through. Now, I don't want to leave you with the idea that the global story is just an entire negative for Australia. There are some medium-term aspects to this story that we should all be very well aware of in our businesses as well. And one way of illustrating that is this very interesting chart that I came across produced by McKinsey's. And what it shows you is how the centre of global economic gravity has moved over the last 2,000 years, essentially. And that global centre of gravity basically shifted from east to west with the emergence of Europe and the Industrial Revolution and so on, and then of course kept heading in that direction as the US took off. It was really only when we got into the 1960s and Japan started to take off, and then of course more recently with China and the rest of Asia moving higher, that centre of gravity has now started shifting back east. The point I want to make about this chart is it took nearly 2,000 years to go from east to west, but it looks like we're going back to where we started from in only about 40 or 50 years. And in fact, you can work out that means the centre of gravity is moving by about 140 kilometres a year, so it's almost fast enough to actually see. But the point there is, what's driving that? Well, what's driving it is big growth in incomes in the Asian part of the world. The number of middle-income consumers in that group is growing at a very rapid rate, and it is delivering some potential benefits to the Australian economy. because as incomes rise, there's a few things we know happen. People spend more money on food, more of it, and better quality. They want access to education. Like everybody else, they like to go on holidays. They want to live in bigger houses or apartments, and those bigger apartments are going to need more steel to hold them up. So there's a whole range of factors here that offer plenty of opportunities to the non-mining part of the economy, but we are going to have to pursue them. One example, I suppose, that's become very topical in recent times, just to highlight what the potential is here, is tourism. The chart on the left-hand side here shows you where Australian tourists, or tourists to Australia rather, are coming from, and the standout, of course, is the increase from China. So over the last 12 months, well over 1 million people from China have been to Australia for a holiday, and there are plenty that haven't been to China yet, so a long-term growth potential there. What we've discovered, though, is that Chinese tourists actually spend more when they're here than any other tourist, which you can see on the chart on the right-hand side. So it's not just more people, it's more people who are spending more as well. So it does highlight, as I say, there are plenty of growth opportunities for the non-resources part of the economy. Asia will remain important for us, not just as a commodity market, but at a market more broadly. And just finally to finish off, certainly 2016 will be a year of challenges. Some of them old challenges running on, some of them new challenges that will emerge. But you'd have to say that after 24 years of continuous economic growth, we're pretty well placed to deal with those challenges. Now I'll finish at that point and leave you to enjoy your lunch. Thank you very much.